Hello, and thanks for joining another dynamic Marshall Reddick Real Estate presentation. My name is Ish Khan, investment analyst here at Marshall Reddick, and welcome to Mailbox Money. It's wonderful to have such a solid group on the call tonight, I must say. It's not easy, knowing it's not easy after a long day to sit down, log into a computer, and focus on improving your financial prowess. I can, however, tell you, though, by engaging with us tonight, you'll accomplish two things. First, you will absolutely learn something new, and second, you'll gain access to very exciting investment opportunity. As I mentioned, my position with Marshall Reddick is investment analyst. I handle a lot of the loan processing inside our private lending division, and I look forward to working with you. My contact information is up on the screen, so please feel free to reach out with any questions at any time. We have a lot to talk about tonight, so I'd like to introduce you to our senior member of the Marshall Reddick team, Mr. Patrick Prunty. Look, when it comes to the nuts and bolts of the real estate transaction, escrow, title insurance, appraisal, or closing statements, Pat really knows his stuff. I come from a commercial real estate finance background, and the last 3 months I have learned more than I have ever before in my finance and real estate career. With that being said, I will hand it over to Patrick.
Ish, awesome. Thanks so much for the introduction. I really appreciate that. It's been a pleasure working with you over the past couple of months. Folks, as he mentioned, VP of Private Lending here at Marshall Reddick and senior member of the team. And by senior simply mean that I've been here longer than the rest of them. So almost 14 years, and I can't even believe it. It's gone by so fast, and real estate's an amazing thing. You know, it never ceases to amaze me that I can learn something new every day. And trust me, I've seen just about every transaction you can think of. In any case, tonight we're talking Mailbox Money. And for Mailbox Money, we're simply talking passive income, which is something that we all really, really want, right? We yearn for this. We don't want to end up like this guy on the screen, right? The goal with passive income is simply to not have to work if you don't want to, as early on in life as possible, right? And our Mailbox Money is going to give you the ability to do that by investing like a bank, all right? So how do you get there? You could certainly play the lottery. Now, that's unlikely for you to get out of your day job by winning the lottery, but some folks like to do it. In any case, I think the better strategy is to simply budget, save, and continually and conservatively invest over time, very much like a bank. And our program is going to allow you to do that by giving you the opportunity to continually and conservatively invest. So what are we actually talking about, folks? Well, let's break it down. You, the investor, the lender, are loaning money to a borrower secured by a mortgage against their property under terms specified by a promissory note. It's that simple, and that's exactly how the bank does it. So, a couple important things to know. There are no Marshall Reddick fees for you, the investor, our lender, to participate in the Mailbox Money program. Second important thing to know, the borrower pays Marshall Reddick a loan fee at closing for setting up their loan. Just like a regular bank, everybody. When you buy your primary residence or when you buy an investment property and you work with a conventional lender, you work with a loan officer, and you're going to pay that loan officer a loan fee to set the loan up for you. So we operate in a very similar fashion, except we're not a conventional lender. We're a private lender. So we've got our flyer on the screen here, and we do have two programs, short-term and long-term, and we're going to talk briefly about the short-term, but Mailbox Money is really about the long-term. So important to take from this, this screen here is simply that there's one lender on each loan, and you own the mortgage. So when we talk about that, the promissory note and the mortgage and things, they're not written in the name of Marshall Reddick or in some other name. They're written in your name as the investor, or your LLC or your trust or whatever you prefer vehicle to lend in. So let's compare the short and the long term side by side. Again, I'm not going to really talk too much about the short term tonight, but the most important thing to take away from the two of these side by side is the risk factor. Okay, so in the short term, the loan amount, the maximum loan to value is going to be based on what we call after repair value. So that's the future value of the property after it's fixed up. And we're willing to lend 70%, we're comfortable lending 70% max of that after repair value. Now, what that doesn't tell you, though, is that in almost 100% of the time, 100% of the case, we are lending 100% or more of the borrower's acquisition. So while I don't consider our short-term program risky, there's inherently more risk than in the long term, which is why the return on investment is greater. Now, greater return on investment is not always better. And personally, I think our long-term program is the best bang for your buck as a lender with Marshall Reddick. So let's talk about the risk on the long term. So the risk is greatly reduced due to the fact that we're lending a maximum of 60% of the appraised value of the property. So the folks getting these long-term loans are not fixing and flipping properties. They're not buying distressed properties. They're buying turnkey buy and hold rentals that are being appraised, and they're looking for private loans of 60% max of that appraised value. Okay, so with that said, let's dive in to the long term. Okay, so 6.5% to 8.5% based on the loan program. Again, these are for buy and hold. There's always a monthly payment, principal and interest, amortized. Interest guarantee, we're going to get into that. And as I specified, no more than 60% of appraised value. Now, it's important to know, too, a lot of times we get lower loan to values. The borrower doesn't always borrow the max, right? Sometimes they just want 50% or even less. The lower the loan to value, the lower the risk, the better we all sleep at night. Okay, who are the borrowers? That's a great question. So although our lending, our private lending is asset-based, meaning there's no credit check, it's based all on the property, we are not chasing subprime borrowers or the subprime market. That's not our intent. That's not who we're looking for. That's not who our borrowers are. Instead, our borrowers are Marshall Reddick clients who, number one, have a self-directed retirement account, and they need non-recourse debt. Okay? The second reason, Fannie and Freddie guidelines, right? Always, 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 as the borrower, you should borrow a conventional mortgage. It's going to have a lower interest rate, and it's going to have a lower down payment. But in certain cases, you can't get a conventional loan, and one of them happens to be if you have more than 10 conventionally mortgaged properties. If you do, a conventional lender cannot make a loan on the 11th, 12th, and so on rental property. And trust me, folks, I've got a lot of investors here at Marshall Reddick looking to build rental property portfolios of 15, 20, or even 50 homes. When they need to get that mortgage number 11, 12, and 13, they have to go private. They come to Marshall Reddick, just like the folks who need the non-recourse debt for their self-directed retirement account. And lastly, and another really common, is a low loan amount. Conventional banks do not make loan amounts under $50,000. There's just simply not enough money in it for them, and it's the same amount of work. That said, they kind of just poo-poo and look down on those low loan amounts. Not us. That's certainly a market that we can service and a good investment opportunity that we can offer to you guys, our clients. So there are 4 loan programs that we have created. We set these terms. Okay? Now, these are the terms the borrower gets to choose from. You as the lender do not get to pick, but you can certainly tell us, hey, I'm only interested in the 5-year balloon. Or, I really like the 30-year fixed. Those are the loans I'm looking for. Okay, so the borrower picks these loan programs, and we make the loans available to you as the investor to become the lender. Now, I'm going to highlight for you guys here this 30-year fixed at 8.5%. That loan, when those come available, it's like gold. The interest rate is so good, and although it's a 30-year fixed, we're going to talk about that here shortly. I'm going to show you why that's the most desirable loan as the lender. All of these programs work for either a purchase money loan or a refinance or a cash out refinance, right? So a borrower coming to us looking to buy the property, that's a purchase money loan. They don't own it currently. They're looking to purchase it in a live escrow. On a refinance or a cash out refinance means that the borrower already owns the property, and either they need to pay off the existing debt that they have, or perhaps they own it free and clear and want to borrow against the equity in that property that they own free and clear. Okay, all of our programs that we just went over have these requirements. Again, 40% down or equity. That's just the opposite of the 60% loan to value. So right in there lies how low risk these investments are. If the borrower's got 40% skin in the game and the subject property cash flows, right, our requirement of net operating income being 25% greater than the borrower's PITI for the sole purpose of covering that maintenance and vacancy that we know is all going to happen, man, there is no reason for that borrower to default, making the risk to the lender extremely low for the types of returns that we are able to get. Of course, we have escrow and title insurance. If you're ever looking at doing some type of private lending with some other group and they ask you, hey, we don't need escrow, you can just wire the money directly to me. You just got to turn and run the other way, right? Do it the right way. The escrow, title insurance, those are third parties that are there to help you and that were set up to make real estate transactions safe. Make sure you use them. We always do. As far as homeowners insurance, well, of course, we're going to require the homeowner, the borrower in this situation, to insure the property. And we're going to have them add you as the lender, as the mortgagee on the policy, just like the bank would. That way, the property burns to the ground, the insurance company is going to write you a check before any proceeds go to that borrower. Also, borrowers got to have reserves. They got to show us bank statements to prove that they've got the down payment and, of course, the reserves. Our minimum is $3,500 or 6 months worth of principal, interest, taxes, and insurance. To illustrate the net operating income, this is something you'd get from us with each investment opportunity, with each loan opportunity. So a lot of you are probably familiar with this. This is how it looks from the borrower's perspective. But this is a 7.5% private loan. That's our 10-year term option. And you can see here I boxed in the monthly income at $322 is well above the borrower's total monthly expenses, right? So it's well above that 25% figure I gave you. Their actual real cash flow then is down at $90, right? But see, that accounts for that 13% of maintenance and 13% for vacancy. Again, that net operating income has to be up there at a high cash flow property, again, to lower our risk as the lender.
Well, Pat, let's take a poll here.
Awesome, that's a great idea. Let's get some interaction from the crowd.
So the first poll question is what has been the average annual return on your investment on your retirement savings over the last 25 years?
Yeah, so if you guys wouldn't mind joining us, please select what you believe your average annual return on retirement savings has been over the last 25 years. Good, we're getting some good responses. We're going to give you guys just a couple more seconds, so please answer. Okay, poll's closed. I'm going to publish and share the results. Okay, so as you guys can see, the overwhelming majority there, 6%, right? So 44% of you believe that your average end return's been around 6%. A good number at 3% and a good number at 9%. Nonetheless, 0% at 12%. And those of you with 9%, I'd like to talk with you guys sometime one-on-one because I certainly need to take some advice from you and invest in what you're investing in, because I think 9% is a fantastic return. I mean, an overwhelmingly fantastic return. 6% I think is probably pretty standard, and I think really everyone probably most likely averages, depending on how long they've been doing this, probably someplace between 3 and 6%. Okay. Now, I share that with you guys, right? Because how does the future look, right? Given low interest rates and lofty stock valuations, the consensus is amongst real estate professionals that we are in for an extended period of low returns. Also, a recently released forecast on the bond and stock returns estimates annualized returns over the next few decades to come in at 4 to 7%. So you guys all kind of agree with that based on our poll, and that's going to be very important to a couple of points we're going to make on the next couple of slides in this presentation.
Let's take another poll.
Awesome, Ish. Good idea. Let's take another poll. So
how long do people generally hold a mortgage before selling or refinancing?
Awesome. If you guys wouldn't mind interacting there with us, let us know. In your thought, how long do people generally hold a mortgage before selling or refinancing? Give you guys a couple more seconds. You got some good feedback coming. Awesome. Okay, we are going to close the poll. And let's publish those results. Wow, exactly what I thought. You guys agree with what the statistics show. The bottom line is that, as you guys agreed, 75% of you said that between 4 and 7 years. And the statistics show that most people hold on to their mortgages for about 7 years. And this is simply a result of their selling or refinancing the loan, at which point the lender who made the original loan gets paid back. Right? So that's very important to take from this as well. Now, the reason I held those two polls is because I'm going to go over the common responses I get to folks who are looking at these investments with us. They say, hey, Pat, you know, I'm looking for a better return than 6.5% to 8.5%. And I kind of look at them and I say, we don't want to get greedy here. I mean, if the average you're earning in the stock market, you know, is 4 to 7% or under 6% or something like that, and that doesn't even offer you the collateral of a real estate property behind the investment, and it's very volatile, I mean, come on. That can't be an inhibitor to doing one of these. And so then I'll ask them another question. Hey, what are you investing in which earns more on average? Are you investing in stocks, bonds, or mutual funds? And on average, is that earning you more than these rates that we can get in this private real estate secured lending? Are you doing REITs, or is it rental property? Now, rental property, in some cases, you can get into these rates and maybe a little bit above. However, rental property, those of you who own it know that it's just not that passive. Now, I'm a big advocate of rental property. I own several rental properties, 12 at the last count, across the country in various markets. And at some point, it just becomes unmanageable, property manager or not. So, again, you can take down 6.5% to 8.5% returns with the security of a property in a completely passive manner. That's dynamite. So really, investors who get it, they adopt a disciplined long-term investment strategy, right? It offers the best balance of principal protection and return on investment. I'm telling y'all, the Mailbox Money program provides exactly that, principal protection and return on investment. These returns are phenomenal. Second common response I get when folks are doing their due diligence. You know, Pat, I really don't want to tie up my money for that long. Your loan terms are too long. Oh, we just did a poll, guys, and you all agreed that the overwhelming majority agree with the statistics, right? The statistics show, again, that 7 years that mortgage gets paid off. So my question is to those folks who always say, I don't want to tie my money up for that long, what do you plan to invest in? Do you ever go into planning and investing in something for less than 7 years? I mean, if you're investing in stocks, bonds, and mutual funds with less than a 7-year time horizon, you're probably going to get burned, right? Unless you're a day trader and you're just better than the gurus on Wall Street. I mean, the folks you guys need to do long-term investing, right? REITs, probably not going into it for less than a 7-year period, and certainly not rental property. I don't know anybody who says, yeah, I'm going to buy that rental property and I'm going to let it go up 20% a year for the next 3 years and then I'm going to sell it, right? That's how people get burned. Now, exactly the same as I shared in the last slide. Again, those investors who get it, they adopt a disciplined, long-term investment strategy that offers the best balance of principal protection and return on investment. I think you guys get my point. So let's talk about the nuts and bolts of a loan. So I've got an amortization up on the screen right now. And for those of you who haven't looked at this before, this is going to blow your mind. But this is exactly how the bank does it. So this is an amortization from one of our loan programs. This is our 30-year AM, 10-year balloon, 7.5%. Okay, so in this situation, top of the screen, the purchase price or value of our hypothetical property is $80,000. Very, very common for our folks investing out of state, right? In that case, they're looking for a maximum loan of $48,000, which is 60% of the $80,000. So I'm asking you as the lender to invest $48,000, right? And I've highlighted that in red box on the amortization schedule because this is something that you'll get from us. So in return for that investment of $48,000, you're going to get a monthly payment of $335.62, principal and interest. And over on the left-hand side of the screen, you can see that that payment doesn't change, and you can see the portion of that payment that is interest, almost all of it, and the very small portion, which is principal. We offer a 3-year interest guarantee on each of our loans, right? And so this loan, on these terms, offers $10,649.27 in a mere 3 years worth of payments. So you can see that in the column here in the middle of the screen, cumulative interest. That's the amount of interest that you as the lender will collect over 36 months at the regularly scheduled payment. The borrower has to pay that amount before they can pay off this loan. We certainly will allow them to pay it off at, say, month 24, but if they do at month 24, they've only paid $7,000 and change, so they've got to pay the difference between that $7,000 and the $10,000 interest guarantee to effectively pay off that loan. Call it a prepayment penalty if you want. Nonetheless, let's go down the long list of other benefits, right? If the borrower makes those payments, those regularly scheduled $335.62 for all 10 years, you're going to collect 119 monthly payments at total of $39,938.78. On top of that, you're going to collect one balloon payment at month 120, which would be $41,997.22. Some people tell me this looks like highway robbery, but I got to tell you, this is exactly what the banks do. That's exactly what we're doing. That's exactly what you can do. So the total interest, if they held this to the 10-year term, which, as you guys all agree, most folks will not. If they did, great. I laughed all the way to the bank and earned $33,936.35 in 10 years of a $48,000 principal investment. Plus, I got my principal back. This is how you become the bank and collect mailbox money. I think it speaks for itself. Okay, other important things to know. This is not a syndication. We're not asking you to invest in a mortgage pool, right? You are the lender. You get to look at the deal. You get to say yes or no. You have control. Non-owner occupied only, okay? Owner occupants, much more highly regulated, a lot more emotion involved, and so our loans are all non-owner occupied, investment based. The minimum investment, approximately $30,000. There is a little bit of wiggle room, but how did I arrive at that number? Easy math. Property value, $50,000, 60% max loan to value, loan amount, $30,000. Now, there are properties valued at less than $50,000, but I don't really want to lend on them. Not that they could always be bad, but most likely they're going to be in not a great neighborhood, not great tenants. So at the end of the day, I think a good rule of thumb is to simply stay at $50,000 or greater, bringing us in at a loan amount minimum of $30,000. It goes up from there. I've done loans up to $500,000. So let's talk a little personal strategy for me. And this is important because a lot of folks ask me, hey, this is great. You know, I'm collecting these monthly payments, but what do I do with the monthly payments? Do I just hold on to it until I accumulate enough to make the next long-term loan? You could do that, but here's my strategy. So I've got a self-directed Roth IRA, and I own property in it. You know, I've done a number of things with it, but really the strategy that makes the most sense for me is I'm taking down and packing as many of these long-term loans, these low-risk loans that pay a monthly payment into my Roth IRA. Right? I collect that monthly payment, and with that monthly payment, I don't just let it sit in the bank and earn zero. I immediately invest it automatically into a very conservative Vanguard total stock market index fund. Right? That's called dollar cost averaging. And what does that do for me? Well, it beats the heck out of my financial advisor's returns. Right? I've got another Roth IRA that, you know, bless his heart, my financial advisor is my good college buddy, but the bottom line is the average annual returns that he's earning for me are nowhere close to what I'm doing in my self-directed IRA on my own with long-term mortgage paper and dollar cost averaging. By the way, any of you folks that need help self-directing, I have the experience. I've helped a number of investors do that. Glad to help you. I can't necessarily set you up with a solo 401k, but as far as an IRA with the custodian, that's really easy, and we can do that together, no problem. Let's talk a little bit about the website. Very cool new changes you guys all need to be aware of. So this is our homepage, and you can see that if you hover over the Invest tab, it drops down and you want to select the Mortgage tab to look at the mortgage investments that we have available. Okay? So when you click on that, it's going to take you to this screen, which is going to be our list view screen, right? It's going to show loans that are available and their loan status and some other preliminary information, right? Then you're going to want to select the filter type, right? So here are the filters. You can select a few there, or you can select this More Filters button. And if you do the More Filters button, it's going to show you some of these so that you can sort and modify, very similar to how our properties section works for those of you familiar. In this case, you're going to want to select Buy and Hold if you're interested in long-term paper. If you're interested in both, feel free to select Fix and Flip or vice versa. You also can select the loan status, available, funding in process, which means I already have a commitment to do the loan, so it's not available for you, but you can certainly see what the deal looks like. You can look at what deals look like that have been funded, deals that have been paid in full, etc. Okay? So after you do that, select the filters you want, you're going to click Done over here at the top right. When you do that, it's going to put you back in the list view with the criteria that you selected and show you only the loan opportunities available that suit your selected filter, your criteria. Okay? So at that point, you're going to want to review, and when you find one that looks good, you're going to want to check the full details. Now, when you click the full details,
folks, as you can see on the left-hand side, it has the loan information, what you're investing in, and on the right-hand side, you will see your returns, the amount that you invested, and basically more information regarding the loan.
Yeah, this detail page is phenomenal. It's going to give you more information probably than you need or want or can comprehend. But here on the right-hand side of the screen is really going to break it down at a nice formula for you. In this particular loan, $40,000 investment, it's a 6.5% yield to maturity. It's a first position loan. Most of our loans are first, but we're going to tell you what they are. It tells you the monthly payment, the interest guarantee, and the potential interest. When you're ready, all you got to do
is fund this loan, and I will get an email directly that you're ready to go.
That's right. When you find a loan opportunity that you like, you're certainly welcome to call us. You can come down to the office if you'd like. We'd love face-to-face and telephone interaction. But the bottom line is all you got to do is click this button. We're going to get word that you want to take that loan, and we are going to move it to funding in progress and take it from there. So a lot of cool changes there on the website. I want to definitely take some time to show that to you guys. Now, another illustration here, kind of like a case study. I have groups coming to me who've done a couple loans, and they say, you know, I've got $1 million in my retirement account, or a good chunk of change in my retirement account, or not even in a retirement account, you know, and I want you to put together a portfolio for me of, you know, a handful of these long-term loans, because I really like what you're doing. And so I have on the screen here a portfolio I put together for a client most recently. These are all long-term loans. These are the actual numbers. So these property addresses are the collateral properties. The loan amounts here were this investor's investment loans. The appraised value of the properties, of course, next. The loan to value. So you can see not all of them are 60%. The interest rates. He prefers the 15-year fix, which I think is a great loan program too, but he did agree to go with this one here at the 10-year balloon, which from an interest standpoint, the options with the balloon are the best, right? The 30-year amortization, really the first 10 years in that amortization schedule is almost 100% interest. It's just phenomenal. So the bottom line here is this investor, he had a little chunk of change to play with, but he invested $212,075, and in return for that, he's collecting a 100% passive mailbox money total payment of $1,726.99. Now these are all individual loans; they're not bundled. He just made them one by one, and we put together this portfolio for him. I can do the same for you guys. Doesn't have to be this big; it can be bigger. Whatever works for you, let's work together and let's get those retirement funds working for you in a very conservative fashion so that you can continue to build. Now, how do you get started? Right? Well, I got our lending flyer back on the screen, but I'm going to bring up the process. Bottom line, we went over, you're going to browse the available mortgage investments at marshallreddick.com. Right? You're going to select an available mortgage to invest in. And then we're going to be into escrow. And you can see, of course, the other items here that get us through escrow, including the title insurance, loan documents, homeowners insurance, all that kind of stuff. Absolutely. Don't feel like you have to be stuck on the website. Pick up the phone. Ish's contact information was there at the front end. My contact information is going to be on the back end. And we're happy to answer any additional questions that you have so that you can be comfortable with the investment. Loan servicing, very, very important, mandatory part of long-term private lending. Okay, chalk this up to a property manager for your loan, just a lot less expensive. So I use Superior Loan Servicing, company like kind of a boutique loan servicer, not a behemoth. They're based here in California, up in Calabasas, north of LA, and they service almost 50 states. So, you know, can really handle the volume. You're welcome to use whoever you like, but loan servicing is mandatory. It really is. The borrower is going to want that. You're going to want that, and I'm going to talk about the benefits. But first, let's talk about the fees. It's very inexpensive, right? There's a these are Superior Loan Servicing fees, by the way. Other servicers have a different fee structure. So with Superior, you're going to get a $30 one-time setup fee. They're going to charge you $20 per month to collect and remit that payment to you, that monthly payment from the borrower. And they have a number of other fees. The only one that I use is this one-time property tax monitoring fee. So you pay them one time, $100 to set it up, and then they check the county records where the property is located every year to make sure that your borrower is making the property tax payment. Very important protection for you as the lender, because property taxes could really take priority over your secured first position loan if they go delinquent. A cool part about the property tax monitoring fee, I charge the borrower that fee at closing. It's on the closing statement, right? And then I have a check remitted by escrow to you as the lender, so you can have that $100 to cover the property tax monitoring fee. pretty cool. I learned that from Wells Fargo. They do that on the loans that I got from them, and I noticed it on my closing statement years after I had made the purchase. And I went, that's pretty cool. So we do the same. As we do the same, most of our stuff is exactly as the bank does it. It's modeled exactly after how they do business. Okay, the benefits of loan servicing. The accounting, right? You don't want to deal with the amortization schedule and the payments, and if there was a late payment, collecting the late payment and all that kind of stuff, right? The year-end paperwork, 1099, 1098, you don't have time to do that. You got to pay somebody to do that, right? Automatic payments. So the loan servicer has a cool website where the borrower can set up automatic monthly payments to be deducted from their account, and you as the lender can set up automatic ACH payments into your account. Kind of takes the pun out of mailbox money because you're not receiving a paper check, but I think it still works. And at the end of the day, you don't want to talk to the borrower, right? Just like you don't want to talk to your tenant when you own rental property. So you put somebody in the middle to handle that for you. And for these costs, it's 100% worth it. All right, what's the role of Marshall Reddick? Right, so of course, we're advisors, right? You guys come to us for advice and investment opportunities. So we provide those lending opportunities, right? We get them all the time. Our other job through escrow and throughout the process of getting the loan funded is to communicate clearly with all parties. So we're talking escrow, title, we're talking realtors, we're talking the borrower, you, the lender, we're talking to the appraiser, we're talking to the closing people. You name it, we handle it, right? You don't have to do any of that. We're going to share it all with you, and you're going to approve everything, but we're going to handle all the communication. And of course, lastly, while we don't expect a default, right? I mean, it's highly unlikely we'd have one considering the borrower's got 40% skin in the game and they've got a very high cash flow property. There's just absolutely no reason to default, even if we hit a major recession. This is almost recession-proof, you guys. I mean, if the property drops 40% in value, you're still sitting pretty at 60% loan to original value. But nonetheless, we here at Marshall Reddick wouldn't expect you to go through the default process on your own, right? You're going to call us and let us know if you have a default. Your first line of security is going to be that loan servicer, however, right? A part of the loan servicing that you're paying for is going to be them making calls and sending late notices if they do make a late payment. Generally, they're not going to. They're going to set up automatic monthly payments, and you're just going to get paid. But if we do have something crazy happen and the borrower just puts their head in the sand or runs away or who knows what, and the payments aren't being made, well, we're going to do what's necessary to go through the foreclosure process and reclaim the property as the collateral. That is the deal. So, last question for the night, at least a part of the PowerPoint. What is the absolute worst case scenario? Ish?
You end up owning the property.
That's it, guys. The bottom line, right? And those of us who understand residential real estate know that, look, if I have a borrower that defaults, I'll take the property, right? I'm comfortable at the 60% loan to value. If I have to do it, I don't want to do it, but I'm not hesitant to do it, right? I know the foreclosure laws. I'll make it happen. I'll take the property, and then it's my choice to do what I want with it. I own it. Right? I can rent it and collect rent. I could fire sell it or sell it. I could fix it up if it needs fix up and sell it. The options are all mine. So if you guys are interested, we need to have a conversation. Right? We're going to be following up with you guys individually. And although we do have a couple of questions, we're definitely going to field a couple here, but we only have time for a couple. So if we didn't get to your question, we'd be happy to do so on a one-on-one basis. I'm going to put my contact information up on the screen. Make sure you guys write it down. Also, we're happy to send you guys the PowerPoint via PDF, and the link's going to be made available on our website to this recording. So, Ish, you got a couple of questions for me?
We do, Pat. The first question is the borrower able to pay more than the scheduled monthly payment, and how does this affect the interest guarantee?
That's a great question. Yeah, so just to reiterate, can the borrower make more than the regularly scheduled monthly payment? Certainly, right? That's called a prepayment, right? So if payment's $250 every month and they want to pay $350, that's great. Okay, that's definitely going to toggle the interest over the long haul, right? It's going to change the amortization schedule, but what that will not change is the interest guarantee. That amount is based on the regularly scheduled monthly payment and is the cumulative interest over the 36 first payments, right? So they have to get you that dollar figure. So prepayments or additional principal payments will not affect the interest guarantee. Good question.
Another question we have is, I understand a default is unlikely. Should one occur, how much does the foreclosure cost and who pays for it?
Right, that's another good question from the crowd. So to reiterate, the question from the attendee is, default's unlikely, they get that, right? But if we have one, right, what does the foreclosure process cost and who pays for that? Okay, so the foreclosure costs vary by state, all right? I've seen as low as $1,200, and that's out of Texas. It's just a flat fee. I mean, Texas is pretty awesome, right? Inside of 60 days, you can have the property on the auction block, right? So there's just no monkey business in Texas, as I'm sure everyone's kind of aware. But $1,200, so $1,200 to $1,500, that's what I see in Texas. That's kind of the low end, and kind of on the high end is somewhere like $3,000 to $5,000. That's going to be in a mortgage state where you definitely have to have an attorney. But still, at $3,000 to $5,000 is not the end of the world. It's not that high of a cost. I mean, a lot of folks out there looking at this think it's going to be a lot more expensive than that. It's not. And yet, the cost is borne by the investor, right? You guys are the ones making the loan. You are collecting the monthly payment. I mean, who knows if we had a default? I mean, maybe it's 6 years into a 10-year term loan, and by that time you've collected, I mean, thousands and thousands and thousands worth of interest. Yeah, you're going to be on the hook. We're certainly here to advise you, as I said, about coordinating in the event of default. But yeah, that's a little bit about the foreclosure cost. Again, it varies by state, but the investor, the lender, bears that cost. We at Marshall Reddick will help you, and we don't charge you to help you, to advise you on kind of the way to get to move forward if there is a default. So no charge for us. But yeah, again, I just want to hammer home that the default is so unlikely, you guys. It's just not going to happen. And if it does, we're just going to take the property and we're going to be A-okay with no loss to principal. All right, so with that said, we're at about 45 minutes. I want to thank everybody for joining the call. Ish, appreciate you being here.
Thank you.
And hey guys, we're looking forward to working with each one of you and getting you into the Mailbox Money program. Have a great night.